Thank you for taking some time to check out this video from NetPicks, and we're going to cover two different types of orders, the stop loss and the stop limit order. Now, I think any trader or investor will agree that protecting your capital is job number one. Think of yourself more of a risk manager. And to protect your capital, you're often going to use two main types of protection, right? To automatically limit losses. You're going to use a stop loss order or you're going to use a stop limit order. Now, stop loss and stop limit orders, they both protect you from losing too much when price moves against you. Now, they are similar in some ways, but they're different enough to be worth knowing about individually. When we talk about stop loss orders, they actually come in two different varieties. One will protect your long position, which would be a sell stop, and another will limit your loss for any short position buy stops. So the common variable with both of these stop loss orders is that they're going to just sit in the market until price hits it. And once the market price reaches the stop order, it's going to be converted into a market order. And that means it's going to get filled at the best possible price. Now, you're going to get filled, right? Guaranteed. But you may get filled at a much worse price than you ever intended, especially when you look at what you originally risked on the trade. Now, let's look over at a sell stop. Now, this stop is going to be used if you are long an instrument. Okay, this stop is going to be set at a price lower than your current price and will be triggered if price declines. So on this chart here, let's just assume that a trader entered long on a breakout of that descending trend line, and the entry price was $325. A sell stop order is originally set at $318.84, and that's going to limit your downside loss. But then as price moves in your favor, we can actually adjust our stop order, right? We can trail it up, but now it's adjusted to $339.40. And that's going to be taking a stop loss order to help lock in profit, right? It's a trailing stop. Buy stop order, we're just going to flip that. So if you're short an instrument, you place a buy stop order above price to exit if the market puts in a rally. So let's just assume that you enter this trade just before the close of the day on the break of the triangle pattern, and you entered at $275.75. So it doesn't matter how you choose to place your stop order. Okay, we're just going to place one. So in this one, I'm just going to use the high, place the initial buy stop order to exit for a loss if price rallies right against you. $284.95 is the price. As the market continually moves down, a trailing stop method would have your final adjusted exit when the current market price became $262.98. That would be your stop loss order. The biggest risk for stop loss orders, because they are treated as market orders when they're hit, sometimes they're going to execute at prices much lower or much higher than your original stop price. So this actually may have you losing more than 1 times your initial risk as your order experiences slippage on some really big price moves. The biggest risk really is having a large gap in price beyond your stop. That could lead to just a massive loss of your trading capital. Talking about stop limit orders, you might find these to be a little bit safer than a standard stop loss because there's some price constraints on your fill price. So quickly, let's know that a buy stop limit is for shorts. Sell stop limit is for long positions. So a stop limit is going to actually combine two different price levels when you set them. The stop price, okay, that's the minimum price. So when the price gets hit, it's converted to a limit order as opposed to a market order. The limit price, as part of the stop limit, is the maximum price, which is the set price or better that your stop will execute at or potentially be executed at. So essentially, if a price makes a large move, hits your stop price, can't be filled at your set limit price or better, you're not going to get filled. And if you can't get filled, usually due to a gap, traders are going to look for price to move back in their direction for a better exit price. Now, these types of traders are using a stop limit order. And they do it, now, barring any large move against your position, okay? It's done to better manage your risk against potential losses. Because they know for the majority of the time, they're not going to face losses beyond what they intended, right? But it's a double-edged sword because price may continue going against you if you can't get filled, and will eventually have to use a market order to exit anyways. So let's look at an example. So I want you to imagine that you're shorting this stock. So you've been able to lower your stop order and price begins to rally against you. So what this chart shows is that you would have a stop price of 262.98. The limit order is 267.73. So once the stop price is hit, the 262.98, the limit order now comes into effect. So you are looking to be filled anywhere from between 262.98, the stop price, and 267.73, which is your limit price. And if price quickly rises from the stop price in a fast-moving market, you may not get filled if price beats your limit price. The other issue is that once your stop price is hit, there may not be enough liquidity in the market to close your entire position. So let's say you're trading 100 shares and only 50 can get filled. Well, you're still going to have 50 shares that are open and they're not protected with any protective stop. So right here is just an example of a sell limit order. So if you went long this stock on the breakout, your sell stop is 31.67 with a sell limit of 31.19. So once 31.67 gets hit, the limit order gets triggered in, and you will, in a perfect world, get filled somewhere between 31.67 and 31.19. Now there's risks, of course, with anything, and they're not really guaranteed to work all the time. Okay, you have to be aware of that. Think about stop loss orders. They act as market orders when they're hit. Slippage, very real risk to your capital. Okay, it's quite possible to get filled at a price point that is multiples of your original risk amount. Stop limit orders may not get executed at all if there are big price moves. You also may only get filled on partial positions if there's not enough liquidity to handle your entire order between your stop and your limit price. So which one should you use? Well, it's actually going to be determined by your own risk tolerance. The main difference really is the stop loss order is guaranteed to be filled. The downside of that is the execution price could be worse than you ever imagined. The stop limit order, now depending on the price movement and liquidity, your order may not get filled or will only get partially filled. But stop limits do give you greater control over execution prices, okay? And the truth is, in the vast majority of the time, you're going to be filled somewhere between your stop and your limit price. And regardless of which one you're going to choose, it's really vital to protect your capital through the use of an order to exit the market. Just pick one that's right for you and your risk tolerance, and one that you're going to use consistently. Hope you enjoyed the video. Hit like, hit subscribe. Talk to you soon.